was the last week of the due diligence period that we canceled the contract. I would say that we found out about it about probably 3 weeks before. And I say we as in the broker, the buyers, the sellers, like we all kind of discovered the situation together while we were under due diligence. And it was just, it wasn't like there's anybody was withholding information, but it was quite the discovery process. And I'm really thankful that we didn't have hard money down. Then it would have become a really expensive experience. So it's kind of evolved my perspective on hard money, non-refundable earnest money deposits to get into 100 plus apartment deals. I think I have a lot more scrutiny behind the owners and did they have a business plan? Did they execute it? Do they have boots on the ground? I'm starting to scrutinize more of the previous owners and not just say, oh, this is a nice asset, I want to get it under contract.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Man, today our guest is going to share about a failed project. What a letdown. What a disappointment this had to have been for him. But he's going to go through some things that were crucial in figuring out that, man, we should not do this deal. And you're going to hear that. You're going to hear about red flags from about the seller, things that you need to see as you're dealing with other owners. And, as they're looking to sell their projects, man, this may not be something you want to move forward on because of these things you're seeing. But then also, he has a unique way of direct to seller marketing that I don't think I've heard of before. So you're going to hear all of that today, along with a few other things, that habits and things I always ask about, because I love just self-improvement. I love helping all of us improve individually, but then our businesses as a whole, even some other conferences and things that he's had success with. But our guest today is Tommy Brant. He calls himself a recovering electrical engineer and data scientist turned full-time real estate investor. He started TB Capital Group as a tool to buy real estate with family, friends, and partners. He helps busy professionals accelerate their wealth through passively investing in real estate. You're going to learn a lot from Tommy today. Tommy, welcome to the show. Honored to have you on. I appreciate you sharing that you are a longtime listener as well, or are a longtime listener, and honored to have you now as a guest. You and I briefly got to connect at the Best Ever conference earlier this year. And so anyway, welcome to the show. Give the listeners a little bit about yourself, real estate, man. What are you doing? Where you're located, and let's jump into this quote, failed deal, and some things that we can learn from you.
For sure. Yeah, Whitney, thank you so much for having me on. I'm both honored and humbled to be here. It is pretty interesting to go full circle from listening to now being a guest on the podcast. So it's quite serendipitous whenever we ran into each other at Best Ever. So glad to be here. So Tommy Brant, I am based out of the Nashville area. I am I'm a recovering electrical engineer of 13 years. I went full time in real estate last August. And so primarily around apartment syndication, although I'd have some long-term rentals, and I'm dipping my toe in the short-term rental self-management space there as well. And so I guess how I kind of got started into real estate was I was a sophomore in college, and I worked for a friend of mine's dad who was a general contractor, and he made mobile homes rent ready. So we're in Middle Georgia at the time, and about 15% of that demographic was post-eviction. So we're coming into some of these units and there's trash everywhere. There's used diapers in the corner. There's hypodermic needles everywhere. And the utilities have been cut off for weeks, and you're playing who's going to open the fridge, not it. And so through that, you do a couple things. One, you build character. Definitely one. But two, you kind of build a vision. So knowing what the end product is going to look like through all the clutter. And so that gave me a lot of good experience. And then 2011, I bought my first home. It was a short sale in a Nashville submarket. And then it was a slow live and flip, and I rented it out a bedroom before I knew what house hacking was to a colleague of mine. And so that kind of gave me my bearings in the real estate space. And then whenever we liquidated that property in 2020, it was a matter of getting educated. And they say more money, more problems. I was like, what do I do with this? I need it to work for me. And so getting educated was a big part of that. And then in a 6-month time period, I bought 3 long-term rentals. Since then, I've invested in 2 apartment syndications. And then we closed on a short-term rental down in Panama City Beach, Florida.
Nice. Wow, you're moving and shaking, that's for sure, to say the least. Well, I want to jump into this 52 unit deal that you quote call the failed deal, but I doubt it was really failed. I mean, I obviously you shared a few details with me, but no doubt you learned a lot, and I would say it's probably a success that you didn't do it based on what we're going to learn today. But let's dive in to that project, and give us some details about the deal, maybe why you liked it, those things, and we'll dive in deep.
For sure, for sure. Yeah. So that would have been my first deal as a co-GP. There was a lot of, it would have validated so much of me, it would have validated my decision to go full time in real estate and build a business around multifamily syndication. So it was definitely a bit of an emotional roller coaster, but thankfully we had some veterans on the deal with us to kind of help guide us and diffuse the emotions out of the situation and be like, look, this is what's going on and this is what we need to avoid. But some of the history on that one. So that was, we'd been building a broker relationship for several months here locally in Nashville. And then we ended up getting wind of the pocket listing, kind of had a good idea of who else was getting wind of that pocket listing. We kind of assembled a team, brought value to them by doing a lot of the upfront market analysis and underwriting and said, hey, like this looks and smells like a good deal. What do you think? And so he got it validated. He brought in some of the remaining team members that we need. And so within a week's time span, we had gotten wind of the deal and had it under contract. And to me, that's fast moving. So just knowing that something exists to now having an executed contract, that was really exciting. But I couldn't have done it if I wasn't networking for several months and I didn't know my market inside and out. So that's definitely a prerequisite to getting any apartment deal under contract. And so that was kind of the history of it. That was a sourcing. So it was a pocket listing from a broker. I guess the lender lined up, but we went through physical inspection. There were some surprises along the way. We were able to talk through those in negotiation. And we got pretty much everything we asked for. And that one, what really kind of killed the deal was the accounting side of things. So the things that people don't think about. So the P&L that was put together in Excel, right, kind of indicated that, there wasn't a lot of outstanding balance. Things were doing well, but the property management franchise that hired the on-site property manager was actually a tenant at the apartment complex, and they weren't really getting a lot of scrutiny behind their operations. They stopped paying rent for a couple months, said, oh, hey buddies, you don't have to pay rent. Wasn't getting caught, was coaching their friends on how to not pay rent. And so this went on for about a year. And so there was $127,000 on outstanding balance, delinquent rents, for the property. And so we brought the lender up to speed. He said, what are our options here? And so he said, all right, well, your 80% loan to cost just went to 60% loan to value. And so that's really close to like new construction, as if like there wasn't an asset there to begin with. And so it's just like, okay, we probably could have still done the deal and paused distributions for 12 to 18 months while we went through this eviction process and release and got new tenants in there. But, in terms of other options, we could have done a master lease option where we didn't really transact, but we said, all right, we're going to take over the property, but you promised to sell to us at this price at Y given date. And but there was just too much risk in that because we didn't really know the person. They weren't local. God forbid they got hit by a bus and their kid said, oh, by the way, I don't want to sell this and sue me. And anyways, there was just a couple things that was outside of our risk tolerance. The fact that a fifth of our capital quadrupled in expense if you compare it to what we would have gotten in an interest rate from a loan to the returns we're underwriting for our investors. And so I guess that's kind of the whole history for the failed deal. But thank goodness we have mentors on that one to kind of ensure that we're looking at return on effort. Do we want to be running through the mud waist high in this, 6 to 9 months from now when maybe we'll be under 2 other deals that are just going way easier?
Speak to the timing of when you learned about obviously the large delinquency. Where were you at in this process, disclosed or not, or when it was disclosed, or how you all walked through that?
We were still within our due diligence period. So we had put down earnest money. It was refundable because there was just hardly anyone this deal was sent out to. So it was about the last week of the due diligence period where we said, okay, we have literally everything else figured out. Let's hone in on these outstanding delinquents. And so it was the last week of the due diligence period that we canceled the contract. I would say that we found out about it about probably 3 weeks before. And I say we as in the broker, the buyers, the sellers, we all kind of discovered the situation together while we were under due diligence. And it was just, it wasn't like there's anybody was withholding information, but it was quite the discovery process. And I'm really thankful that we didn't have hard money down. Then it would have become a really expensive experience. So it's kind of evolved my perspective on hard money, non-refundable earnest money deposits to get into 100 plus apartment deals. I think I have a lot more scrutiny behind the owners and did they have a business plan? Did they execute it? Do they have boots on the ground? I'm starting to scrutinize more of the previous owners and not just say, oh, this is a nice asset. I want to get it under contract.
Makes a ton of sense. No doubt about it, who that seller is, right? I mean, the level of professionalism that they have, or how the level that they operate at professionally, and even down to how they're treating their employees and their tenants and all those things. Because guess what? You're inheriting a lot of that, right? That culture as you take on that project. But, you mentioned, you didn't have hard money down. And but it was under contract. And so what was the process there when you were going to have money down, or, what did that look like? Or maybe you had some earnest money in, but it wasn't hard yet.
Sure. Yeah. So I guess in terms of the due diligence period, I guess we kind of structured it as a 30-day due diligence period and then kind of another 30-day window there. And then we put in the ability to purchase 30-day extensions based off of 0.25% of purchase price. And so, that would help us navigate if there are any issues with the loan and stuff like that. But the due diligence period doesn't start until we get all of our documents. That was kind of how we worded it in the contract there. And so while it took about 3 weeks for us to get everything from the previous seller. And so while we were doing that, we were talking to the property manager. We were lining up roof inspections, plumbing inspections, building inspections. And so really the day of due diligence started the day that we were doing our inspection. We were on site. So we were very quick about assembling everything in order, making sure we had the ALTA survey, appraisal was done, yes or no, that type of, or at least ordered.
Are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team that I've created, they're now available to produce shows for you as well. We can do as little or as much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing other valuable tasks on your business. Let me know you're interested by emailing me directly at whitney@lifebridgecapital.com.
Yeah, no, that's great. I appreciate that. It's helpful just as a listener to think about that process that you all took. What about, what were maybe red flags that you started to see about the seller? When did you see them? Maybe some lessons learned around working with the seller. You mentioned like that's something you're doing, maybe personal due diligence on before you even think about the deal. What were some of those lessons learned, and what did you see in the seller?
Yeah, I actually really like this question, Whitney, because there's a number of red flags that we should have kind of expected something to pop up. But I guess one example was they didn't really have a team. That was probably the biggest red flag. It was just a solo owner that had syndicated. I don't know if there were maybe people in the background that they had, maybe mentors kind of guiding them or whatever, but there was only reference to one managing partner in this deal. And so that was pretty interesting. So they didn't have boots on the ground to tell them what the on-site property manager was or wasn't doing. They weren't getting any feedback about the property outside of what was being given to them by, the on-site PM. The other, I guess, kind of glaring part to me, but I see it all the time, is they didn't execute any value add. They've owned it for about 2 years. And what's funny is like the inspector that we hired to inspect this property was the same inspector that inspected it 2 years ago when they bought it. And so the inspector comes on the property. He's just like, I could probably just resend you the same inspection report, that I used 2 years ago. And we actually did. But he was just like, everything, all the red flags that I pointed out are still existing, and they've advanced in severity. And so just knowing that there wasn't anything executed, that like he didn't add any, generally speaking, as a multifamily syndicator, I'm thinking you add value to the common areas first. Like let the tenant see that you're improving the place before you do interior renovations. So I'm thinking order of operation. So, but there's, they're saying that like the foundation issues or subfloor issues have been outstanding for multiple years. There's like entire tiles missing in breezeways where, kids could fall through. The handrails have been loose for Lord knows how long. And there's like a solid crack down one of the foundations. It's not like, hairline across the cinder blocks and stuff like that. And so the couple instances where there's just been neglect, and it's just like, this needs like a capital injection and needs to be addressed. And you should have done this 2 years ago, by the way, when it was recommended by the inspector that we hired today. And so, yeah, but what's funny is like, I see that all the time. I'm walking properties around the Nashville area, and there's people that bought something, 2 or 3 years ago, and they've really enjoyed what the market's done. And they said, you know what, like I'm getting increased rents. I'm hitting my year 5 projections and year 1.5. Why would I bother putting my capital back into this place? And, when I can transact and sell again. And, I guess that kind of goes against everything I've learned. So I would consider that a red flag for the operator, but I see it more than I should, I feel like.
No doubt that's happening a ton, or has happened over the last couple of years. It's like, man, we can charge so much more in rent and we didn't have to do anything, any CapEx, right? No doubt there's tons of people that are cashing in on that. And so you do have to think, consider that, right? They've done no improvements. That doesn't mean it's not worth more, right now, of course. However, you're noticing things like the crack in the concrete or the foundation, all those things you were mentioning. And some of those you may have already even known about, right? But what was it? Was it the delinquency that you all found out about that finally was like, okay, we just can't do this deal because of that? Obviously, that changed your debt, those things. But was that the initial thing that changed everything to saying, what, we can't do this deal?
It was, because the physical surprises, I'm doing air quotes, but listen, the physical surprises, like we were able to talk through. We got quotes probably at about $150,000 in surprise CapEx based on the foundation issues, subfloor and joist, just issues in every single building. And so we were able to talk through that. We took that off the top line purchase price. We were trying to repurpose some of the money. So instead of, we budgeted about $250 for new roofs. And, the roofing inspector said, hey, based on recent storms, you could exercise an insurance claim and you'd probably pay higher insurance premium, but you'd be able to repurpose that $250K for other projects around the apartment complex. And so they were, on board with that. And so like the physical surprises were not an issue. It was definitely the delinquencies and kind of the impact that would have to our investors, and that just the elevated risk for a profile for that type of deal just wasn't really something we were comfortable with.
Yeah, no, that's awesome. I appreciate you just elaborating on some of that, especially the red flags for the seller and things that any buyer right now should be looking for as they're moving forward on deals right now. But you also, I want to switch gears a little bit, because you also have a unique approach to, say, direct to seller marketing. And I'd love to walk through that a little bit. I know that's something that, people want to know right now. Right. Everybody's looking for that deal. They're pretty hard to find right now, obviously, with interest rates doing what they're doing. And today's a big day for that. I haven't heard how or what's happened yet as far as today, or maybe that decision hasn't been made yet. But anyway, tell us a little bit about your unique approach, and let's dive in.
For sure. On the interest rates, I was actually looking it up this morning, and I'm just going to shaking my head about what's going on. But anyways, what goes up must come down one day, hopefully. But for the direct to seller stuff, it's actually pretty unique. I think when a lot of people think direct to seller, they think, I can't do that, or I don't, maybe I don't like talking to people, or that's a burden, and I need to pay for a list, and I need to skip trace this, that, and the other, and they get really lost in really the marketing side of things. Before they even start, analysis paralysis, you hear that all the time. And so we kind of partnered with someone to do that for us. It's actually, so we're partnering with a broker to help us through this process. So they are the front line, the face. What makes this unique, aside from partnering with a broker, is that we're finding properties that fit our buy box. So we're looking anywhere from Louisville to Huntsville. Obviously, that includes Nashville. And then East Tennessee, we're looking for 30 to 200 unit, 1980s or later build. We're using Reonomy just to understand inventory. And then we take the properties that fit our buy box, and then we send the addresses to the broker. And we're like, can you give us CoStar reports? Give us rent comps, sales comps, give us an underwriting report that's generated from there. And so we look at and identify what are the ones that has rents top of market, automatically pass, disqualify those. We look for stuff that has a gap between market rents and current rents. And then we underwrite based on assumptions of maybe expense per door, or, expense ratio, 45%, 50%, whatever makes sense for the market. And then our first touch is an offer letter. And so, if you compare that to historical direct to seller, where it's like, hey, Mr. Owner, I'd love to give you a free evaluation of your property. Can you just give me T12 rent roll due diligence? And they start asking for stuff, right? So it's like, they ask, and then give, whereas we're trying to give first to kind of make ourselves stand out. And so the broker handles the initial touches. That really the magic is in the follow-up, honestly. And then they do the follow-ups, every month or quarter or what have you. And so that gets us, non-competitive environment and direct pulse to some of the apartment owners.
Awesome. I appreciate you walking through that process. I want to ask you a little bit about your partnership with the broker. And so you're using Reonomy is a software that helps you find that information about properties, right? I've heard of that. Maybe we've even had the founder of that on the show years ago. I can't remember now. It sounds familiar. But ultimately, you have the partnership with the broker. You're finding the deal through the software, all the details. You're underwriting it. You're asking for the CoStar report. What's expected from the broker then? Are they then taking your offer to that owner, themselves and kind of working their normal process? But you found the deal. What does that look like? That partnership?
For sure, yeah, because it could go a couple different ways. Right. It could get to the point where broker goes to the apartment owner and says, "Hi, I have buyers ready to buy at this price." Really, it's just kind of sitting on a table for a quarter. So if we wanted to revisit it, we'd have to update our offer anyways. But it's just saying, "Hey, I have buyers for this property. If you're interested in selling or transacting," I imagine it'll go one of two ways at that point. Yes, my partners and I do want to sell. We'll talk about it. It's got to make whatever return for us and our investors, and that's going to be our price point. And that's either going to fit in our buy box or it's not, right? If it's a property that is, outstanding and super polished, and they want to sell for retail price to an institutional investors, probably not us. That's probably going to be a situation where we let go and say, "All right, broker, do your thing." I know it'll come back to me because I believe in, in karma and the circle of adding value, and what that looks like. So I don't expect any sort of kickback in those types of scenarios, but it's a volume game. Right. If you look at the funnel of I need to generate so many leads to underwrite so many deals, to get under contract in so many deals, to close on something, I have to make my own leads. And that was our decision to do direct to seller since the turn of the year.
Okay. Wow. Yeah, that's awesome. I appreciate the color to the process and or just speak to using that software. Has that been something, is that like a deal changer? I mean, is that something that's like, man, this has just made it for us using this software? What would you recommend around that?
Sure. I would say that Reonomy compared to CoStar, I mean, we're in middle of 2020 when I'm kind of citing these processes, but you're looking at probably $400, $600 a month for Reonomy, right? Split between two people. That's okay. To CoStar, which is like a mortgage. So in terms of like what's low hanging fruit for the masses to kind of get their hands on and just kind of accept that data quality is what it is. Maybe it's just the law of averages. It's directionally correct. It's been super important for us. There hasn't been anything else that we've been able to find that's low hanging fruit for us to understand commercial inventory.
Okay. No, that's helpful. And I thought you said 2020 there, but ultimately the middle of 2022 right now,
sorry.
Right? That's all right. That's all right. Just want listeners to know that. So that's helpful though. That's helpful to think through, well, is that a software that maybe we should consider trying to purchase right now, as somebody that's looking for deals, the listener is thinking about their budget potentially and what that looks like for them. Well, Tommy, shifting gears just a little bit to a few final questions here. With your experience in the market now and even the software that you're using, all these things that you're seeing, obviously, what do you predict over the next 6 to 12 months? And how is that changing your all's buying strategy or is it?
Yeah, I've been waiting for this question all day, Whitney, even all month. But so I guess my predictions in the market, I've actually put a little bit of this on my LinkedIn feed, but there's like some indicators, indicating that if we do go into a recession, that the Fed is likely to decrease rates historically, right? If we ever go into a recession, maybe a couple months, quarters after, the Fed is going to lower interest rates to try to stimulate the economy. So yeah, I kind of half joke that the sooner we go into a recession, the better with regards to interest rates and everything like that. So I think that the Fed right now is looking at pausing after September. But I think that they're having to overshoot, knowing that they need to come down eventually to get the economy healthy again. And so I think we're going to go into a recession. But I think that also historically, the longest recession has lasted 18 months. So I think interest rates are probably going to come down within an 18-month time span.
I think that's an interesting metric there to know as well, as far as the 18 months. And if you could even just run some worst case scenarios on the projects that you have right now, like, could we survive for 18 months? Right. Mm-hmm. You got to be able to survive it. Right. When there's a downturn, man, are you prepared? I always ask, about, people say, about reserve budgets and those things, how they think about being prepared for a downturn. And are you prepared? Can you survive 18 months? Some people say, they're ready to survive like 6 months. And that makes me a little nervous, Yeah. So that's good to think through as well. But maybe, you can help us with that as well. Like, how are you all prepared for that downturn if you're thinking about, those metrics?
Yeah, our fundamentals haven't changed. I preach this all the time. It's like you need to be buying cash flowing assets with ample reserves and opportunity to add value. And so, I think it's getting harder to find the cash flowing assets with some of the debt that's out there nowadays. But that's, the plan doesn't change. Just keep looking.
What's your best source for meeting new investors right now?
Right now, I actually broke this into a pie chart, honestly. But so it's like a third is from my past life. So my professional colleagues.
I was going to say you are a recovering electrical engineer, right?
Yes,
Data scientist. Yeah.
For sure. Yeah. And so I'd say about a third is just from, we'll call it the friends and family ecosphere. And then a third is from meetups in the form of conferences. Real estate investor and, not. I go to some business conferences and entrepreneurial conferences, stuff that service the real estate industry, but are not real estate investors. And then the other third is just a huge amalgamation of people that I've known or been referred to. So,
what business or entrepreneurial conferences would you recommend, like outside of the real estate industry?
Yeah, I'd say for me, like if I break it down to my customer avatar, right, it's probably 30 to 65-year-old working professionals, real estate professionals, and then just generally speaking, maybe business owners who are looking to shelter some taxes. And so conferences that I go to are probably servicing the business owners and real estate professionals, and you can marry the two. So a conference I was at last weekend, for example, was it had realtors, it had mortgage brokers, it had title, escrow attorneys, stuff of that sort. And so that was a great source where, if you're a real estate professional on your tax filings, you get to really benefit from investing in apartment syndication.
What about what are some of the most important metrics that you track? That could be personally or professionally.
Once a week, I always track the number of people that I talk to, and then also the number of offers that we make. And so those are, I'm tracking the activity, right? There's your leading and lagging goals, right? So I'm tracking the leading goals, knowing that eventually it'll lag and get into some substantial milestones. So making sure I'm networking and being active in acquisitions.
What about some habits that you have that have produced the highest return for you?
I'm a big follower of Hal Elrod and the Miracle Morning. And I would say that you have to have balance, right? You can't build a Tower of Pisa, and expect it to go forever, right? So you have to be balanced, have all of your pillars equidistant and growing simultaneously. And so I'm always meditating. I read and I write every single day. I go through my thankfuls, what I'm thankful for, and then just my focus. So what do I need to do today for today to be a successful day? And then after that, it's pig-headed discipline and determination and intense curiosity, I think would be.
What's the number one thing that's contributed to your success?
Oh, I gave it away. Yeah, pig-headed. So it's like three things, but pig-headed discipline, determination, and intense curiosity.
Awesome.
If that's one thing, we'll say that's one thing.
Yeah, that's great. What about how do you like to give back?
Right now, it's my time. So I just got back from a couple of coffees this morning from people that probably aren't going to add value to my business, but I love talking about real estate. And so they're asking me questions about the short-term rental business or how do I get started in multifamily, this, that, and the other. And that's my jam. But I love talking about that. So I'm happy to talk to anyone and everyone, passive or active investors. If there's any way I can add value, I'll do it.
That's awesome. Tommy, pleasure to meet with you again and to have you on the show. You definitely added a ton of value today and going through this failed project, right? And I was thinking about the disappointment that probably was the time because you mentioned like this was going to be the one that was going to allow you to go full time. And man, I can just feel the letdown, right? Of when that happened. But man, I bet you're thankful now that it happened that way, right? Ultimately, if you had done the deal, it may have caused you to it'd be even longer before you actually got to leave your job, right? So appreciate you just being real about that, sharing about that deal, even the red flags about the seller. I think it's very valuable. And then your unique approach to direct to seller marketing and partnering with a broker, doing that research yourself, and going directly, with an offer, to that seller. That shows you mean business, no doubt about it, and that you've done some homework. So thank you for sharing that. How can the listeners get in touch with you and learn more about you?
Yeah, thank you so much, Whitney. I appreciate the platform that you create here and all that you do. So if you want to learn a little bit more about me and what we do, we've built a platform on tbcapitalgroup.com. So Tommy Brant, capitalgroup.com. If you want to know a little bit more about multifamily investing, I wrote a book on there. And so there's definitely a download that you can learn more about. It's a free resource. I do not monetize that at all on tbcapitalgroup.com. But if you want to get in touch with me, my calendar is on there, actually. So tbcapitalgroup.com/connect. We'll pull up my Calendly, and then you can grab any 30-minute window that aligns with your schedule. Other than that, I'm on LinkedIn and Facebook, Tommy Brant. Come find me.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.